It will be hard for the Fed to cut much more without making that last mile progress all the way to 2%. I take it more as a reminder for diversification rather than indicia that something kind of broken. There are real manifestations of the geopolitical unrest that diminish the impact on financial markets.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Fun discussion today with Simeon Hyman. Simeon is the global investment strategist at ProShares. I met Simeon at a conference down in Tampa earlier in January. Really appreciated his perspective on global markets, on equities versus fixed income, and a lot of different sort of macro themes. So I invited him to come on the podcast and share his perspective. I'm super glad I did. I think you'll appreciate his discussion about the sustainability of the rally in gold and other precious metals, expectations for the Fed and the 10-year as we brace for the first Fed meeting of 2026 this week, risk assets, valuations, leadership themes. We touched on a little of everything, but I think what Simeon will do for you is help you understand how investors can think about and appreciate all these different macro themes and how to translate that down to specific positioning decisions. So please enjoy this interview with Simeon Hyman of ProShares. Super excited to be chatting today with Simeon Hyman. Simeon's the global investment strategist at ProShares. Simeon, it was awesome to meet you in Tampa a couple weeks ago, and great to have you on the show. Thanks for coming on.
It was a lot warmer there.
We're fine here in the Pacific Northwest. It's pretty normal, but for much of the country, this is the frost has hit, winter has arrived. So I'm good. You're in the Northeast, right? In the New York area.
Yep.
Okay, good. Well, I'm glad you're here. You appear to have power. That's all awesome. So a lot to talk about, obviously, right? We're in the midst of a pretty serious earnings season where already we're seeing a lot of movement around earnings releases. We've got the Fed meeting this week with a lot to think about. The dollar plunging, major geopolitical trauma. I'm not sure if we have anything to talk about, but we'll do our best. So start us here if we could, right? I mean, one of the big, the most important things people have been thinking about is affordability, interest rates, inflation, all play into that story for consumers. We have the Fed meeting this week. The market not pricing in any particular change at this Fed meeting, the first Fed meeting of 2026. But do you have any expectations about what you would expect to hear from Chair Powell, or expectations about what investors should be thinking about in these first couple meetings where we're just looking for clarity, right?
Lots and lots to unpack, as people like to say. But
yeah.
Here's a frame that I think is really, really simple. We call it the 2-3-4 frame. That just simply says that if inflation gets to 2%, then a good guess for Fed funds is 3, and the 10-year should be 4. So where are we? Well, inflation's in the high 2s, Fed funds is high 3s, and the 10-year is not too much past 4. So what does that mean? First, and importantly, it means that the 10-year kind of already is close to pricing in, or approximately pricing in, a long-term expectation of getting to that 2%. That's important, and we'll talk about stocks in a minute, but it's important to thinking about PE multiples and all of that. With respect to the Fed, what it means is that the easy cuts, if you will, are done. In other words, it will be hard for the Fed to cut much more without making that last mile progress all the way to 2%. Because right now, you could argue that Fed funds is about 100 basis points higher than either PCE or CPI. So that's why I think you see the market saying, maybe we're not going to get one in the next couple of meetings.
Those are all really, but that 2-3-4 frame, I haven't heard that before. That's actually really cool. That's a great way to think about the relationship between each of those different metrics, to be sure. I feel like there are times, Simeon, and even in the last couple of years, there are times like mid-cycle where it's obvious the Fed's going to raise rates a quarter basis point every meeting, or there's a cut cycle and it's clear. The inflection points, right? The end or the beginning, that's when it's kind of a game, right? And kind of figuring it out. So where are you anticipating a rate cut? Do you think that's something that's pretty clearly expected at a certain point? Or do you think it's going to be more about hearing what we, or listening to what we hear from the chairman?
I don't think it's imminent. And one way to see that is to acknowledge the good place that the economy is at. And by that, I mean that the soft landing has in many ways been accomplished. You can look at this from a lot of different directions because the business cycle is important here. There aren't really any imminent signs of a recession because a recession comes from overheating. So let's look at where we are. On the ISM measures, the 50 is the break-even guide between contraction and expansion. And let's just cheat a little here. Manufacturing's been in the high 40s and services has been in the high 50s. We'll take an average on that. I know I'm oversimplifying a little, but that guy's kind of in the middle spot. Yeah. And then I look at an old school metric called capacity utilization that I think many people have forgotten about. And the old rule of thumb on capacity utilization is that when the economy is cranking past 80%, 80 on capacity utilization, that's when you're overheating and you might have a recession around the corner. Now, right now, we've been in the high 70s for almost a year straight. And people get this wrong because historically, the bounds of capacity utilization have been kind of 75 to 85. So if you're in the high 70s, that's a sweet spot. The reason people get it wrong and think that high 70s is high is because twice in the last 20 years, meaning the great financial crisis and COVID, that guy went lower than we'd ever seen it into the 60s. But even if you go back to the early 70s, 1973, capacity utilization bottomed out at like 75. So if you're looking for a quintessential picture of a soft landing, it kind of looks that we've achieved it, which means two things. One, that the Fed doesn't have that much pressure to cut because at least the economy seems to be in a relatively robust place. And if anything, I would argue that the most likely reason for more than maybe one more cut is a weak labor market, and that's what we don't want. So if we can avoid softness in the labor market, then I'm not sure that the impetus for a cut is so close.
Really interesting points there. And so your comments about some of the economic data, I mean, completely, I think spot on. I appreciate that. When you think about, you'd mentioned, sort of the 10-year yield with that 2, 3, 4 frame, right? The 10-year yield kind of in the general place where that sort of lines up. Do you have an expectation of where the 10-year goes from here? Because I'm always thinking about what investors are not prepared for. And I feel like a rising rate environment is one that people are probably generally underprepared for. But what are your expectations here in the months to come? And how should investors be thinking about it today?
The fixed income market as a whole, you've got a little bit of a conundrum because your money market yields, the short end, have come significantly down over the last couple of years. But exactly to your point, if anything, there's a risk of a mild sell-off on the longer end of the curve. Because if you think about that 2, 3, 4 framework, what it says is if we get stuck with inflation, technically inflation expectations that are too close to 3%, you could see a mild sell-off on the long end and see the long end go into the mid and high 4s. It's not a big number, probably not that much to mess with equity markets too much. Yeah. But you know what? You take duration, you multiply it by the change in interest rates. You don't really want your safe money to find its way to even a 3 or 4 or 5% decline on the safe money side. So I think you're right that people should be aware of the challenges on the fixed income side. It's just not a simple hold it and forget it across the board. Things like ladders and also things like income from sources other than fixed income certainly are relevant for 2026.
We can't just go to sleep. We still have to pay attention to the markets, I guess, right? I guess that's a good point here. So tell me this, one thing we haven't talked about, the dollar rotating lower pretty aggressively, through events in Davos last week and today, again, the dollar kind of coming down. How does a weaker dollar and what we've experienced so far, how does that fit into this general picture of economic strength in the U.S.? The weaker dollar seems to imply sort of a lack of confidence in some ways. What does that weaker dollar mean to you, and how could that impact investors here in 2026?
I wouldn't get obsessed with the path of the dollar. I mean, look, the dollar had risen for so long and so substantially that a little bit of a pullback certainly should be expected. But you wouldn't find, us in the camp of sort of de-dollarization and concerns about budget deficit and things like that. I think it is an important reminder, though, that, and it seems, It kind of always annoys me when you talk to strategists and they say, well, diversification. But yes, we know that for the first time in many, many years, international equity markets, actually did very, very well last year and continue even in the first month of this year to outpace U.S. markets. And don't hedge that currency risk. Leave those international equities in their local currency format. That's an important piece of it. And look, we've all seen what's happening on the commodity front. That is another important piece of diversification with respect to the path of the dollar or the path of equity. So I take it more as a reminder for diversification rather than indicia that's something kind of broken.
No, great points. And I think, coming from a technical analysis background, we always talk about diversification just for diversification's sake. Often not a great idea, but diversifying into things that are quite strong, and are showing opportunity, never necessarily a bad thing. I think a lot of investors were surprised looking back at 2025, given the strength in the S&P and the NASDAQ, decent year, given the dominance of AI as a major investment theme, that non-US markets outperformed, and then gold and silver, right, even more so. You'd mentioned gold, and gold and silver had incredibly strong 2025s. Already in January, they've gone vertical in a lot of ways, continue higher. Gold pushing above $5,000 an ounce this week. How do you interpret a market like that has already had the run that it's had? Because I know for a lot of investors, it feels way too late to be chasing something like that. What gives you confidence or a lack of confidence on the trend in gold and silver persisting in some way? Or how do you think about that relative to other asset allocation decisions?
I'm always using the lens of the strategic and tactical asset allocation, which means you have a baseline allocation and you usually tweak things. But you typically don't completely ditch them because none of us are clairvoyant, if you will. But I do think that it's certainly worth noting as an example that Bitcoin has de minimis correlation with both silver and gold, which is kind of cool. And by the way, de minimis correlation, I shouldn't say de minimis, but much lower correlation to the tech sector than people think. So I think you have to look even beyond just classic commodities for diversification in this environment. And look, we're getting a reminder of it just this week in the cold with nat gas going through the roof. So it isn't just silver and gold. There are broader assets out there, and of course oil prices are at all-time lows, so if you're kind of a contrarian in that sense, that may be an opportunity as well.
Really good points. You'd mentioned you'd brought up Bitcoin, so I'll go there briefly if we could. Bitcoin at times, I remember years ago when people are still trying to get their head around this whole cryptocurrency thing, it felt like a relationship to the dollar. At times it's felt like a risk off asset. It's been a risk asset. A lot of times it's traded sort of in line with equities, but Bitcoin, Ethereum, both have kind of come down quite a bit. How do you think about cryptocurrencies at this point in terms of an asset class, and how should investors think about that as part of a broader allocation between equities, paper assets, and everything? Where does it fit in, or where should it fit in for investors?
We were super proud to launch BITO several years ago, getting out in front of this. I think the key, there are a couple of pieces here. Number one, again, don't just follow the tape. I'm not a technician, so the folks should use the technicals if that helps them get in and out. But in thinking about this over the years, I think it is very important to note that the correlations are lower than you think. And if you want to think about this in just sort of a storytelling mode, it was only a couple of years ago that the crypto-related financial institutions, in technical terms, kind of went kaplooey. Yeah. And when that happened, by the way, Bitcoin went up. And it's also important to look beyond Bitcoin. I'm not the guy who's going to talk about every level of the blockchain, but just some simple things folks should know. Bitcoin is only a store of value. Ethereum has utility on the blockchain. And there are other coins too, like Solana and XRP. We've got a whole suite, but I think folks should, number one, understand that it's not just a risk asset. It doesn't move with tech stocks. It's moving differently than commodities, and it's not just Bitcoin. And if you remember those three things, I think that helps put together an appropriate sleeve in an asset allocation.
Oh, fantastic takeaways there, Simeon. And I would wholeheartedly agree, right? Looking at these things constantly from a technical perspective, people love to oversimplify and try to label something like Bitcoin or Ether as a certain type. It's a risk asset. It trades with the dollar, it trades with gold. The relationship is actually quite fluid. And in some ways, that's probably one of the more attractive parts of that asset class is it gives you a differentiated return stream, as we would say, right, from something like equities.
If you're doing a correlation matrix and you change it from daily to weekly to monthly, you're going to find some different answers to your point.
It moves around, doesn't it?
There isn't a simple answer.
So to pivot a bit, volatility is something that I know a lot of our viewers pay attention to closely. The VIX is currently right around 16 or so, which is relatively low given its historical value. So the options market kind of pricing in not a lot of movement. However, it feels like our life volatility, our geopolitical volatility, policy volatility seems incredibly high. So how do you think about the volatility, which has remained fairly low in the face of what feel like very volatile conditions? I get a lot of questions about why isn't the VIX way higher given how crazy things have been, whatever that means to people. So how do you think about the relationship between kind of, the world and volatility versus actual volatility as we would measure? And what are your expectations for volatility? Is this an aberration that the VIX has remained so low? Or how should we be thinking about volatility, good or bad, kind of going forward?
I think part of the reason that volatility is low is that some of the geopolitical events have less implications and I don't mean from a humanitarian standpoint, we'll leave that aside, but if we're simply looking at the impact on markets, you look at Venezuela and, the damage had been done over 20, 30 years such that they're not making much oil right now, so not much happened. Okay, so there are real manifestations of the geopolitical unrest that diminish the impact on financial markets, and that's certainly part of what's going on. And also the taco trade thing is also part of the reason that the market got a little trained after Liberation Day, that a lot of the stuff that might hit the headlines might not actually happen. So when you put those two things together, you have an environment where the VIX might not be tracking the geopolitical headlines. But the other thing that's critically important to volatility is the fact that, and this was the title of our 2026 market outlook, that it's not Y2K. We have lower equity prices from a valuation standpoint than we had at the end of 1999, and much stronger fundamentals. So that in and of itself helps to diminish volatility in the equity markets.
Oh, really, really good points in there. And I would wholeheartedly agree with some of that, Simeon, especially the fact that anytime there's a big, scary news headline, of which I feel like we've had plenty recently, I get a question about market impact. And for so many things, regardless of how important they are for some reason, the market impact is often, sort of de minimis, right? It's minimal. And again, until it isn't, and that's what we all have to be ready for, is that thing we don't know is going to start moving the markets here. You had sort of mentioned with your 2026 market outlook, it's not Y2K. We were at an event where Kathy Wood spoke about, AI valuations and tech companies and all of this. I'd love for you to share a little bit more, if you could, tease out that idea. I think so many people are seeing AI as an obvious bubble. They're seeing valuations as ridiculously high. How can we keep going when we've had the run that we've had? Can you tell us a little bit more about how this should or should not be compared directly to what we saw in the late 90s with high valuations with the dot-com era? How do you think about that relationship today?
Sure. Just in straightforward valuation terms, the tech sector was at over 55 times earnings at the end of 99, and we're in the mid-30s today. But profit margins and return on assets are substantially higher. That can't be ignored. But what we are seeing is and this is also goes to comparing to the beginning of this century, we're seeing a broadening of the equity markets. As we talked about before, it started in 2025 on the international side. And this year, and even at the tail end of 2025, we're seeing an expansion into other areas of the equity markets. Very notably, mid and small cap stocks have been outperforming large caps so far incredibly strongly this year. And then also other areas of the equity markets. We have a suite of dividend growth ETFs, ticker NOBL. The S&P 500 Dividend Aristocrats is our flagship. Old school quality companies that have increased their dividend for 25 straight years. They're substantially outperforming the S&P this year, and it actually began a couple of months towards the end of 2025. So the sort of secular dominance of just that Mag 7 trade looks like it's expanding. I mean, if we had sat here a month ago and thought about where the equity markets would be if the Mag 7 didn't participate, I don't think we would all have said, well, the market would be fine, but it is. Yeah. And that's a very, very powerful sign with regards to the health of the equity markets.
You had mentioned small caps, Simeon, and 100% agreed. I feel like many investors were waiting for small caps to finally take on some sort of leadership role. It didn't come through 24, kind of 25, but then toward the end of last year, you start to see the Russell 2000 break out. You're starting to see it outperform here in the last couple months. How do you think about, I think for so many investors, at least that are newer, they've been trained that big growth companies are kind of the play. And when the market's going up, we want to buy big growth. Now, all of a sudden, NVIDIA is kind of at the lower end of its range and small cap names are breaking out. What fuels that breakout in small cap stocks? And what would give you confidence that that could be an emerging theme that would strengthen through the course of this year?
There are a couple of things. First, you just can't ignore valuation. Now, valuation, particularly for the folks who have the technical piece on their minds, valuation is tough to make a timing decision on. But small caps are absolutely pretty darn close to the cheapest relative to large caps that they've ever been historically. So that's one piece. The other piece is going way, way back, just about 15 minutes to the top of our conversation. If you think about where interest rates are and what the Fed might do, PE multiples on the large cap side are primarily influenced by the longer end of the curve, which what we've suggested is that they're going to be range bound with a modest lean towards actually slightly higher longer term rates. So that doesn't help large caps, but small caps are sensitive to the short end. So part of the rally has been the Fed cuts, even without a move on the 10-year. And if we squeak out one or two over the course of the next year, that can be extra fuel too. So those are a couple of the things. And, we've seen a couple of ways that folks who we work with have been seeing as opportunities to take advantage of this. And one way we frame it is in the moniker of income now and income later. And what I mean by that is if you take a dividend growth approach, like we were just talking about, not only do we have NOBL, our S&P 500 dividend aristocrats, but we have SMDV, which is our Russell 2000 dividend grower. That's a really nice way to stay exposed to small caps with high quality companies that are making money. A lot of the Russell 2 doesn't, and grow their dividends over time. So you have a growing income stream. But in this environment where there's that challenge on the fixed income side, getting some income now from equities can be a very good idea too. And here we have ITWO, and that's our Russell 2000 high income ETF. And what it does is it uses a very innovative daily approach to covered call writing to generate income from that Russell 2000 universe, but targeting the full return of that equity index over time. So that's a nice way to get income now, income later, and get nifty exposure to small caps at the same time.
No, thanks for highlighting some of those, Simeon. I know in preparing for our discussion, I checked out the list on the ProShares website. It's pretty good, diverse coverage of the equity landscape and other asset classes as well. So congrats on giving, and thanks for giving individual investors a lot of levers they can pull in this environment. I think that's been one of the great evolutions of the market here since I've been involved over the last 20 some years here. Finish off if we could, one of the, I guess, question marks, right? When we think about traditional leadership, the things that are just starting to work pretty well here, energy comes to mind, materials certainly, and it's, besides the precious metals, it's steel companies, it's chemical companies, right, are also doing pretty well. These are generally kind of like late cycle leaderships, right? Things that tend to lead toward the end of a bull market phase. Does that, I guess, the downside of this big, broad rotation is the things that are starting to work are things that often tend to work toward the later stages of a bull cycle. Does that enter into your thinking at all? Or is it more just a sign of a healthy expansion that we're getting more and more participation here?
So one part of this is yes, you buy energy stocks when oil is cheap. You don't buy it when it's expensive. So there's that, which
Right.
which is sort of the classic answer to that. But I go back to the soft landing.
Mm.
If we saw signs of an overheating economy, then I'd be in that camp of saying, yeah, it's really late cycle. But how are we late cycle if capacity utilization is 77 or 78? How are we at late cycle, when ISM manufacturing is 47, 48? It
Yeah.
just doesn't seem like we have that overheating component. The risk, I think, is slightly to the other side, that we could have a little bit of economic weakness. So I think that's more of a risk than being late cycle overheating.
Really, really helpful. Thanks for framing that out as you did, Simeon. So final question here. You guys at ProShares have done a great job giving investors access to different asset classes and equity, sleeves of the equity market. But also, I know you do a lot with education with your work and your team, kind of, helping people understand how the markets are moving. What would you say is the biggest behavioral mistake for a podcast called Market Misbehavior? What is the area where you find investors have behavioral challenges? What's the mistake that they make? And how can they work on it here in 2026?
I think you really have to make sure that you are aligning the way you're managing your money with the mandate. It's okay to have some of your assets for which you have a shorter term time horizon, which may mean that it has to be in cash, or it may mean that you have a shorter term investment horizon and you are more willing to take shorter term. I hate people calling them bets, but shorter term trades with respect to a shorter term view for those assets. But if it's the retirement bucket, you kind of don't want to yank that up and down all the time. So I think if you're very clear in your mind, even if you don't write it down, it's the investment policy statement that must be the true north. And that's the thing that can control misbehavior. Write down what the intent of the different buckets of assets that you have, so that whenever you're thinking of violating that, you go back and you say, okay, the investment policy statement for this one, it said it's 70-30. It said my time horizon is 20 years. Okay, this guy over here, it's 100% equity, and I need it for college tuition in 3 years. The investment policy statement, I've always been trained, is the place that can really help control and avoid misbehavior.
That is awesome, Simeon. I've worked with a lot of institutional investors. That was a key part of how they would sort of set the table for a really good string of performances, is that policy statement, that laying out explicitly what they're going to do and how they're going to do it. Individuals, advisors, I hope that are watching realize the benefits that can do to help you stay focused. Simeon, this was awesome. It was so good to meet you in person in Tampa. I was excited to get you on the podcast. You did not disappoint. Thanks for coming on the show today. I hope we can continue the conversation down the road. But in the meantime, on behalf of our viewers, thanks so much.
Thanks for having me. Appreciate it.
Really appreciate Simeon Hyman's perspective. Thanks again to Simeon joining from ProShares. Really good discussion. I think I in general really agreed with his general assessment on things, particularly with the Fed meeting, how to think about interest rates, the short end versus the long end of the yield curve, what the 10-year yield means, what slightly higher rates could represent, and which areas of the market could benefit or struggle, right? Given that shift. Thought his take on the dollar was really interesting. I've heard a lot of warning signs, a lot of, the sky is falling kind of discussion because of the falling dollar environment. I think Simeon appropriately pointed us to economic indicators, things like capacity utilization, which we've not talked about often on the show, but a great point that, as long as the economic data is strong, weaker dollar maybe not as much of an issue. Late cycle leadership like energy and materials, maybe not so much of an issue because the economic data, at this point remains in a position of strength. Thought his question at the end, or his answer at the end about, what investors do, poorly that they could do better from a behavioral perspective. His comment on a policy statement, right? A one-pager that describes your intention as a portfolio manager. This is an exercise that I did in my Fidelity days when a new fund manager would start a new fund. They would have to write up a kind of one-page document explaining, here's what I'm going to do, here's how I'm going to do it, here's how I'm going to think about positioning, here's how I'm going to think about risk, Here's how I'm going to balance idea generation versus risk management. Here are the tools and resources I'm going to use. And it was all laid out. It wasn't left to chance. It wasn't left to whatever the portfolio manager felt like on a particular day. They would have that document and they would often have it hanging in their office. So they would always be looking over just to make sure, is what I'm doing right now helping me get to the goals that I've laid out for me and my shareholders? I have found individual investors don't do that nearly enough, right? Or really clearly articulate their game plan, their approach, how they're going to do it. Because how are you going to really determine when you're following off the rails? How are you going to determine when you're developing bad habits if you haven't listed out what a good set of habits and routines looks like? So if you haven't done that already, do that sort of one-page policy statement. I would encourage you to take a shot at it. I think you'll find you learn quite a bit. Great take overall by Simeon Hyman on the macro themes. And again, generally, what I loved about him and looking at the ProShares ETF lineup, there's a lot of different areas from currency or from commodities like precious metals to cryptocurrencies to equities, styles and themes. The dividend income portion of their funds really allowed us to go to a lot of different places on that conversation. I thought his comments on cryptocurrencies and how to think about it, by the way, really, really good point. And I would say from a technical perspective, he is absolutely right by the fact that cryptocurrencies generally have had a relatively low correlation with stocks. We tend to think of them as very highly correlated. It's actually a very fluid relationship. Same with gold, which is one of the reasons why it's ended up being such a great safe haven, because the returns are kind of different from stocks in a lot of ways. By the way, if you want to learn more about how to make better decisions, how to avoid some of those behavioral pitfalls that you can run into, how to understand the relationship between macro themes, but also the flickering ticks of the markets and recognizing trends and momentum and breadth, our Market Misbehavior Premium memberships can be a great opportunity for you to upgrade your own decision-making process here in 2026. 3 benefits of the premium membership. First off, all of our virtual courses will be available to you on demand at your own pace, like Flight School, Behavioral Investing, where we teach you all about the relationship between behavioral finance and technical analysis. Number 2, you'll have access to our member reports, like our monthly chart review, which we'll be coming out with next week, first week in February, our weekly flight plan, which comes out every weekend, and a lot of great random market updates as market conditions inspire. Finally, you have full and immediate access to our member community, where you can ask questions, where you can learn from other like-minded investors, and you'll have me as a mentor watching, sharing some helpful resources and nurturing you along your way toward more mindful investing. All of that can be yours today if you go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for this episode. Thanks so much for following me and my work. Thanks for listening and watching to the Market Misbehavior podcast. I'm Dave Keller, reminding you it's always a good time to own good charts.